But let's invite another management, Canara Bank. They reported actually a bit of a subdued set of numbers at a time when the industry growth is very, very strong. The corporate loan growth, well, it continues to remain strong, but declines on a sequential basis. The positive, though, was the asset quality, as the gross NPAs came at the lowest levels we've seen in the last 30 quarters. Well, to discuss this and more, we're joined by Mr. Satyanarayana Raju, the Executive Director at the bank. Hi, sir. Good morning. Thanks so much for joining in. Well, I guess the street wanted a bit more growth from you, but I'm looking at your guidance numbers, and for the next year, you're guiding in low teens with some margin expansion, closer on 3.05% on the NIMs. Now, the gold part of your portfolio will have to play a role, right? That's grown by close to around 30%. What kind of a growth are you factoring in on the gold loan portfolio, if you could tell us that? And also, what is the average yield you're getting currently on that portfolio?
Yes, sir. Actually, the credit growth, whatever we are given it, even the last year, just let me explain here that the last year, whatever we are given the guidance, it's an 8% to guidance, as against that we have shown 16%. But this year we have projected that we are given a guidance of minimum 10.5%. These are all the minimum numbers, but we are sure that we grow much above than that. Last time in interaction, I committed to you that our growth will be around 12 to 14%. And the same thing, definitely we are confident that we can achieve that our credit growth a minimum of 12 to 14%. But when you are giving to that, these are all the, you look at that our goals and actuals, so whatever we have given it there, except the CASA, we have performed exceedingly well in that. When it comes for the gold loan, as last year, it's not that for last 3 years, we are consistently growing in the gold loan. On an average, we are getting, if you add that the income, fee income and all, the average yield will be around 9.10. So that's a good income when our average yield is only a 7.45%. So that's where actually now, because in India, gold loan requirement is there, but that's the first option for the people is a Canara Bank. We could establish ourselves in the where there is a gold loan portfolio is very strong, especially in the south. Now we are entering into that west and even the north, there is a good traction in that. These are all because all over India we have focused this.
Yes.
That is helping us in that growing such a high percentage. Early South India used to contribute, now across the country is contributing.
Got it, sir. So the gist that we're getting away is on the loan growth, the credit growth, you're being given a conservative guidance and you're confident maybe you can go ahead and achieve that. Now, your gold book, I'm looking at it in the last 2 years, it's moved from around 80,000 odd to around 1.23. So that's been 2-3 lakh, which is a very, very good growth. Could you break up the book for us? How much of it is agri? How much of it is retail? I think there's a difference of around 100 basis points on the yields out there. So tell us more.
No, actually, these are all the, our 59% of the total branch network is in rural and semi-urban. We get more traction in the gold loan only from these areas. So it's a dominant factor, especially in the Telugu states, Tamil states, Malayalam states, Karnataka, and to some extent is the West and all. There, there is a high potential for this, the gold loan portfolio. So since majority of this, the purpose of is that we have a retail gold loan credit of around 6 to 8,000 crores. The remaining is the some part is there in the for other purposes, commercial purposes, as 2 to 3,000 crores. The remaining is in the agriculture purpose.
Okay, got it. So, I do want to ask you about your ECL provisioning norms and the kind of impact that it would have on your bank. Can you give us a little more details on the ECL provisions? How short of the requirement are you? And how much is the extra provisioning that you'd have to make in FY24?
No, actually, madam, yesterday when I am discussing with the analytics, I made a point to say that we are very strong in capital. When the discussion has come for that, are you planning for raising any capital? So actually, we are at our CR, AR is at 16.68%. So it is the best among the peer banks. And current year and next year, we are not planning to come out for any equity rising. But definitely in the tier 1 and the tier 2, we may look at that because there may be some maturities. Because next board meeting, we are going to the board for assessment of requirement. And based on that, we will come out, we will share with you the figures. And regarding ECLs, is the probability of default we can assure you that we will be the one among the lowest in the peer banks, because that our SMA portfolio, whatever it is, the downward trend, and our slippages in the last quarter, what's the downward trend, it is showing that these two will give a confidence to the investors and the stakeholders that our loan book is very quality wise, it's very strong. So whenever once the RBI guidelines comes to us, so because unless otherwise the guidelines or draft guidelines comes out, we cannot freeze those numbers. But what my explanation to you is, we are well prepared for whatever it may be, and I am sure that we will be the market driven in the peer banks.
So the RBI has allowed it to be spread over 5 years, but in that context, can you tell us ballpark what would the provisions be in the first year? And I'm trying to understand that, will these higher provisions impact your return ratios in any way in FY24?
No, not at all, madam. Not at all. That much I can assure you that.
Okay. And any ballpark number that you can share with us on what the provisioning could be?
So clearly, madam, then we can freeze it. It is only assuming the things. So once the guidelines comes out, we will share that exact requirements to you.
Okay, Mr. Raju, you've given us, you put out a whole set of guidance for FY24. Would you like to put out a sort of overall number, because overall slippages still remain high, I think at about 1.5% or so, as compared to 1.2% last quarter. What would you like this number to be around in FY24? What can you do?
I say this is the 1.32 as on date, sir. Actually, it has been earlier, it was more than 2%, just 1.5 years back. We could brought it down to that 1.32. On a quarter-on-quarter basis, it is a slippage. The slippage ratio is around 0.34. We are looking at that the 0.25. We want to do that in the current financial year. Though we have given at 1.3 to our guidance to the stakeholders, but internally we aimed at for 1%, the slippage ratio. That we want to work out towards reaching that 1%.
Okay. On the loan growth target that you gave us earlier, right? Can you tell us where the demand is coming from? Is it from capex-based corporate loans? Are you seeing a lot more working capital loans? Just trying to understand whether the corporate capex cycle has picked up.
So here I would like to say something that, madam, it's actually even last quarter, our corporate credit growth was good, but it was not reflecting in our figures, because in the overseas exposure, where that last 3 quarters mean that there are some short-term loans we have extended to our Indian oil companies of our Indian government, PSUs. There is a short-term loans, and that's being repaid that short-term loans, and they may avail it in the current year also. That's why that corporate growth, it looks that the last quarter it is subdued. But actually the domestic corporate credit, there is a good traction is there. We have more than 20,000 sanctions in our hands, and it is happening in almost in every sector. Mostly the infrastructure, it is there. What we are doing that last 2 years, we are continuing to do that. There is a good proposals on the data center, creation of data centers and all. And there is a demand in the manufacturing side, even in the engineering and food processing also we are looking at. And green energy, we have ample sanctions. We are even traction is there to expedite our credit growth. Now we are almost every week we are conducting our sanction committee meetings so that we can address that. But there is a construction, the engineering side, cement, steel, it is there. Green energy, it is there. These are all the areas what we are looking at. Even in the pharmaceutical side also, we have seen that there is a traction.
All right. So, with regard to the stake that you have in some of your subsidiaries, any plans of paring any of that down? Canfin, Homes, could we expect something in FY24, or at current reckoning it's not on the cards?
No, let me share it with you, sir. Actually, all our subsidiaries and associates, they are performing. Now only it has started performing very well. So far, we want to take as much as possible out of these subsidiaries. We are advised that our subsidiary of Canara Robeco Asset Management Company and Canara HSBC Life Insurance Company to initiate for listing in the shortest possible time. It may take 15 to 18 months to complete the formalities, but we are interested to go to the listing of these two. The Canfin Homes also, you are already aware about that the MD has come, he has taken the charge, he is under full control of that. And there is a good traction in that, even in numbers there is a good growth in the first 1 month. We are looking at actually the value will be increased much more. Our internal task is to make it a double the value of that, our share in these subsidiaries and associates just within 3 years. So when we are working on that to take out a maximum from that, our subsidiaries, the benefit to the parent organization, at this moment we don't look at any disinvestment from our subsidiaries. Rather, we are working more on improving our value of the subsidiaries, sir. Our target is to make it double that value within the just 3 years.
Okay, value unlocking is top of mind. Now, just one question, Mr. Raju. This is not just for Canara, but some of the other PSU banks which have reported numbers as well. You know, treasury income, bad debt recoveries, these are things which in the quarter that we've seen numbers for, that's the fourth quarter, they've contributed to between 25, 30, 35% in some cases of operating profits. Is this going to be a large, chunky figure for you as well, sir, in FY24? I mean, the projections that you're giving us, you've not given us the earnings guidance for 24, but could you tell us if this is going to be chunky for you?
And actually, treasury, it has not contributed for us a good income in this quarter too. So, because of the market, you know that the higher rate of interest and higher these things, the treasury has not contributed much. Definitely, I agree with you that recoveries in our return of account is given a good cushion to us. But that's not the only case that we get into, that it is contributing to our operating profit. You can look at that there is a growth in the fee income also. And if you focus on last 4 years, our income receiving from the recovery in return of accounts is, there is a steady growth. And that growth will continue because we have almost more than 65,000 crores return of book. We don't want to leave that book just like that. We want to recover as much as possible through the proper recovery channels. But we are also focused on the fee income. Then the first quarter we will get, because of our high priority sector lending outstandings, we get a huge income in the form of selling in the PSLC in the first quarter and second quarter. That type of income support may not be there in the third and fourth quarter, but the first 2 quarters we will be very comfortable in raising the income, even whether the treasury income improves or not. So our figures will be taken care by our other income.
Okay. All right, sir, we've gone on for a goodish bit. Thank you for joining in and clarifying on a lot of issues and also talking about the growth for the bank. That's Canara Bank talking about the growth and, of course, the ECL provision issues as well.